Hey everyone, hope you're having a nice Thursday. Paolo Quiroga here, founder of Maven Group Investment Strategies, and here obviously to give you an update on what's going on. It's been an interesting last few days, and if you're confused on why we're seeing the markets react so negatively when the Fed didn't make an interest rate hike, I'm here to tell you why. So it's been a while since we've been on here. Obviously, that means we haven't seen much volatility this year. And since I'm here, volatility is back. So as promised, when the markets drop 5, 10, and 20+%, we're here to help provide some overall knowledge on why it's happening, what to expect moving forward, and give you some actionable ideas on how you can either take advantage of it or continue to protect yourself. So today, looking at the markets, the S&P 500 is down 5.6% when you look from peak to where it closed today. The NASDAQ is down 7.9% from its highest point, and the Dow is only down 4.4%. So again, it's still, not down too much overall, but here in just the last couple of days, it's been a little more volatile due to the Fed coming out with their overall speech and talking about what they expect here for the end of the year. So why and what caused the movement that we're seeing so far? So the Fed said, hey, we're not going to raise rates, but we're still not sure if we're done yet. We're going to be kind of cautious here at the end of the year and indicated that there's likely going to be one more rate hike to go. So that I don't think that was much of a surprise. I think what the market's actually anticipating is now the fact is that they indicated there's going to be less chances of rate reductions next year. And I think that's why we're seeing more downward movement than what you would imagine normally, just because the market was pricing in more rate reductions going into 2024 than what was shown now. So all of that is, making adjustments in the market today. And you always have to remember the market's looking ahead, trying to forecast how the economy is going to look and trying to price that in now, as opposed to immediately and taking in today's information, forecasting that out for 6 to 12 months in the future. So that's really what caused all this movement, and it doesn't mean it's done today. Where we could see it going, so when we look at our research team and they give us our technical analysis, ultimately for the S&P 500, our research team is saying, hey, there could be support right around 4,300, which is basically where the market closed today. If it goes past that, then we have additional support at the 200-day moving average. So that would only be, an additional 3% drop. So either way, this is a good opportunity to really take advantage of. We don't see it as being a, more of a long-term detriment to the market, but more of a short-term correction. So here's where we come up with basically our 3 actionable ideas. And this is something we've actually been talking about for a while. So the first thing is reviewing your risk tolerance. So if it's something that you haven't looked at, definitely reconsider. Last year being such a challenging year, this year the market started off really strong. Take some time to adjust and think about, are you invested appropriately based on your risk tolerance? Then second, based on your risk tolerance, are you invested in a way that aligns with that aligns with your risk tolerance, aligns with your goals? Where we see a lot of people making mistakes is maybe they're a little overly aggressive and not knowing that, or they're way too conservative compared to their goals and where they need to be. So look at your risk tolerance, look at your asset allocation, and see where you can make some improvements. Specifically areas that we see and that we've made adjustments proactively for clients, both on the small and the mid cap space. So again, both of those are more growth oriented, a little more volatile, and historically don't tend to do as well in a high interest rate environment. They have more debt than large cap counterparts. So it's a little more challenging environment. And considering we may see rates stay higher for longer, that's 2 categories that we see continuing to face headwinds and more challenges moving forward. So those are 2 areas of your portfolio that you could look at. The last thing is obviously taking a look at your 401k contributions. If you want to increase your contributions or it's something that you've been thinking of, now's the time to do it. Take advantage of the fact that we're having this pullback and make sure that you're getting more of your money in and working for you. Vice versa, if you just have cash sitting on the sidelines, now's a good time to evaluate where you can put some of that to work. We've seen, again, interest rates continue to increase over the last year and a half. Considering that there might be an end to those rate hikes this year, bonds could actually start seeing some recovery going into next year. So when you look at the risk reward balance between stocks and bonds, bonds have started to become and look more attractive. So actually in July, our research team came out and said, hey, we're actually going to downgrade our equity outlook from being positive to more neutral, basically just because of how well they performed to start the year, and increased our outlook on bonds. So before all of this kind of volatility started taking place, we were proactively going through and de-risking a lot of client portfolios that we manage internally, and keeping some cash on the sidelines and just adjusting to areas of the market that are less correlated to those equity positions. So those are additional things to consider. Obviously, we're here for you. If you have questions, don't hesitate to reach out. Lastly, I want to leave you with what's normal within the market, because volatility is always in the market. It's nice having a continuous growth, but it's not normal. And the way we started this year isn't how the market's going to continue over the next few years. So remember, 3 times a year, we see the market drop by anywhere from 5 to 10%. And that's just regular news headlines coming out that shakes the market up pretty quickly, but it recovers fairly quickly as well. Then once a year, we typically see the market drop by 10 to 15%. That's a correction. Again, that's something where the market's reacting to news that's coming out and having to readjust valuations based on where we expect to see the economy in the future. And then lastly, a 20% drop or more, your standard bear market. We just went through that last year in 2022. So we typically see that once every 4 to 6 years. So if you're just thinking in the law of averages, we typically will see a few good years before going into the next bear market. So again, we haven't even fully recovered from where the markets were at their peak of December 2021. So we still have road ahead for the market to continue moving. So again, take advantage of these points of volatility, look at it to make some adjustments in the market. We're going through and rebalancing. But at the end of the day, if you have questions, you want additional resources, don't hesitate to reach out. We're here for you and hope that we can help you as soon as we can. So thanks for joining us today and hope to hear from you. Take care.